New Year's Eve to all of you from Dave and from me, from everyone here at Traders Reserve. Thanks for joining me for our first ever annual trading review. We'll be doing more of these in the future. I'll come back to that at the end of this presentation. Want to spend time not only talking about what worked, what's changing, what to think about, what to look forward to for 2025, but also give you some perspective on the year behind us and how that can help us and affect our thinking in the year ahead. So without too much more preamble, I want to share a little fun story, and there's a point to it, which I promise I'll make here in just a minute. This is my Christmas story. Each year, especially now that the in-laws are in the senior community living facility, Liz and I host her parents and their closest friends for a Christmas Eve dinner each year. We've been doing this for a number of years. And my father-in-law's menu consists of fried walleye, pierogi, creamed herring. I'm sure you all love that. Sauerkraut and pickled red cabbage. Not my favorite menu for Christmas Eve. Unfortunately, this year, her dad called on Christmas Eve morning and said that her mother had caught a cold and we were going to have to do the dinner without them and to please host their friends for them on their behalf. 30 seconds later, that menu changed to prime rib, baked potato, green bean casserole, asparagus salad, and homemade tomato soup. Something to think about as we go into the new year. When you're handed fried walleye, pierogi, sauerkraut, creamed herring, be willing to change the menu. We are, I believe, looking back at the last 6 weeks, facing a market that is going to be very similar throughout the year next year, which means you will want to be nimble, and cautiously aggressive, we'll put it that way. Don't be afraid to change direction in the new year, meaning if you want to be more aggressive or if you want to be more conservative, don't be afraid to take that step. I don't know what this year is going to bring. My one prediction, and the one prediction that Dave and I were correct on earlier this year, is that all other predictions will be wrong, as they were. So we have no idea what this new year is really going to bring, but the last 6 weeks are instructive and give us some idea of what we have to look forward to in the new year. As we get there, I want to say Happy New Year to all of you. I hope you have a great new year, a great 2025. We'll do everything we can to make 2025 even better than 2024. And certainly across all of our services, there's room for improvement. We always look for those opportunities and where we can focus our energy to better serve you in both the education and in the trading end of things. But overall, I'm actually pleased with how this year has gone, considering the number of changes and challenges we've had to face together. I want to start with some things that will be changing that I can share with you right now. We may be making some other changes as we go through the first quarter, and we'll share those when it's relevant. But I want to start with the Traders Reserve Live website. One of the newest additions is the trading calendar. This calendar doesn't have much on it for December because we didn't release it until nearly the end of the month. But this calendar will now provide you with a view, either weekly or monthly, of all of the training sessions that are scheduled across the services and instant access to the room from within any of the events scheduled. So if you click on an event, it will bring up the details of the event. We'll continue to add more around some of the details around these events. But this just gives you an overview of what's happening on a daily basis so you can plan your day. Remember that this is still version 1 of the calendar. There are other improvements, including a potential feature for you to add to your own calendar. But the developer is still working on that end of it. So this is the first stage in this calendar. There are a couple of different views using the icons. One at the very, very top, we'll just give you a quick list of, I believe, just today's particular webinars, and then the two calendar icons in the middle of the screen, sort of in the middle top of the screen. Those will give you either a full month view or a list view. So a list of events throughout that are scheduled throughout the month. So feel free to use that. And again, as we make additions and or improvements to it, we'll keep you posted and updated. For Options Income Weekly members, a couple of things that we plan to make changes around. Number one, given the more limited number of high quality stocks to trade at less than $100 a share or lower than $100 a share, we are going to have to bring vertical credit spreads, that's a bull put spread, to Options Income Weekly. We're not going to trade these on a high frequency basis. Options Income Weekly's objective will remain a training program for investors who want to learn how to sell options for income. But given the experience, for example, with Intel this year, worst year ever for Intel, and a number of other stocks that we may have traded and more or less gotten lucky to avoid negative events like stocks being assigned, stocks falling, etc. We need to be able to broaden our horizon inside of that service in order to be able to be effective and to be profitable. So beginning at some point in 2025, we will begin teaching basic credit spreads, especially for newer members, as we bring newer members into Options Income Weekly in the new year. They'll have a starting point. We will continue to sell on the single side, a put and or a covered call, depending on what Dave is trading at any point in time. But part of the focus here has to be on training, on trade management, on capital allocation, to be able to take advantage or to tackle higher quality stocks that are trading at much higher prices. Options Income Weekly continues to be intended for investors with a $50,000 trading account. This can be scaled, obviously, for larger accounts, those recommendations. But it's intended to be the learning ground. So our monthly income goal for a $50,000 portfolio will be about $500 per month. We may make fewer trades, especially as we execute spreads, so that we can take more time to explain putting the spread on, managing or watching the spread, setting good till cancels, getting and exiting the spreads. So as much as I know many people out there may not like spreads, there's a justification for needing them versus using them. And the needing them right now is the higher quality stocks are at plus $100 stock prices. If you want extreme moves, by all means, trade those stocks that are like Micron and Intel, et cetera. We don't want to use those types of stocks, so we are going to make that change and bring spreads to Options Income Weekly. We may trade multiple contracts with those spreads because the capital will be far less. So there are capital allocation advantages that we may be able to take advantage of. So we might trade two contracts versus one. Same thing on the single-sided put. We're largely going to trade one contract. So be aware that that will be coming, and so you're not surprised. I'm not sure how soon we're going to roll that out. I don't expect it to be on day one in January, but throughout the month of January, we'll start working toward this process, this approach. Next up, for the three-stock strategy, if you are already a member, you should have received the update yesterday. I think it was yesterday. I told you basically I'm going to make some modifications to this. Jeff and I will be working on this as we get into January, February, March. First is to remove the limitation of trading only the S&P 500 stocks and to be broader and wider across the indices and the stock market at large. We're still not going to trade penny stocks. I'm still going to have more or less a price limiter, which is stocks above $10 or maybe even $20 per share. But I want a broader approach because given the volatility in the market that we've experienced just in the last few weeks, the rapid changes we've seen in Wall Street moving capital from sector A to sector B to sector C to sector D over the last, not just the last 6 weeks, but over the last 6 months, we need that flexibility. We need to be able to move outside. Want to be able to take, if I want to be able to take advantage of a small cap stock that may have significant momentum in a 30 or 60-day period. Or again, being able to balance ourselves between high priced and low priced stocks. So that's number one. Number two and three kind of will go together. We're going to be a little more flexible on our entry dates, not strictly limiting it to the first of the month. Same on the exit side. We may not exit exactly on the last day of the month. We may carry trades over as we have done with Palantir, which has paid off as Palantir is running at about a 40% gain. We may close trades during the month, which means we might hold stocks for 10 to 15 days and take an 8 or 9 or 10% gain and then replace it with another stock that has the potential to do the same thing in a shorter period of time. This means that three stock will be somewhere between 3 and 6 trades per month. I don't believe that's going to be a significant increase in the amount of time in that service, time spent trading. So maximum trades would be 72 if we were trading out all three stocks every single month of the year, which I don't foresee. But I think we'll be somewhere in that 36 to 72 range. That should have some positive impacts. First, in increasing the compounded rate of return. My goal for this year is to get back in the 60s. We're going to be somewhere in the high 30s to low 40s, depending on how our final three stocks, when I close them, either later this week or beginning of next, how those perform at the finish. So a little more aggressive, but not at the day trading level, not holding stocks for one day or anything like that. I mean, if the stock goes up 30% in one day, I might tell you to take that gain, absolutely. However, really looking for stocks that have a consistency and momentum. But it's that since May of last year, sorry, June of last year, when Jeff and I noticed that almost exactly at the middle of the month, there were consistent shifts in sectors, and that in some instances, not all, negatively impacted trades that we were carrying. So we waited until the end of the year so that we could continue to assess whether or not that was still happening, which it is. We've seen that this month with the rapid shift out of mega cap tech. And I think we'll continue to see that as Wall Street hunts for profits in 2025. Expectations for next year, some things to keep your eye focused on, but remember that we're always watching it for you. Right now, 10-year Treasury yields are a minor but becoming major headwind on stocks. Treasury yields above 4.5% are stock negative. They just hit the other day. They were at 4.7%. That was back on Friday when we had the big down day. We need Treasury yields to be lower. I'll show you that on a chart here in just a minute. But the long end of the curve, the bond vigilantes, the bond market is signaling less confidence in the forward momentum of the economy, and therefore demanding to get paid on their money with higher yields. You can also look back on an S&P 500 chart in July and fall of 2023 and even April of this year, when Treasury yields breached that 4.5%. You can see the impact on the stock market in the short term in each of those periods was anywhere from 2 to 7%. So beware, if Treasury yields continue to push higher, that is going to have a negative impact on the market at some point. But we'll keep our eye on that and let you know when we want to be more cautious about things. Number two is the labor market. Right now, we're in what I would call a no hire, no fire labor market. That is continuing jobless claims. People who have been unemployed for 6 months or longer continue to rise slowly, while at the same time, weekly jobless claims continue to be at fairly low levels. So across the breadth of the economy, businesses are not firing people, they're not laying people off, but they're also not hiring people back. So that, again, tells us that there is uncertainty at the business level about next year. So it is a category to watch. It has impact on everything from retail sales, consumer spending, housing sales, et cetera, across the breadth and depth of the economy. If the labor market changes negatively, that is going to be a significant event. If it remains stable, as it has for months on end, then things should be fine. We should not be any better or worse than where we are at the present time, but it's worth watching. The other major trend that I'm watching right now is artificial intelligence. I know it's everybody's talking about it. Every company all of a sudden has AI something. Um, how a company produces garbage bags using AI is beyond me, but there you have it. So, biggest thing to think about when it comes to artificial intelligence in 2025 and even into 2026 is this: chip stocks cannot be the only companies profiting from AI. Businesses leveraging AI, either business to business or business to consumer, at some point those profits need to come from some other sector or some other level of the economy in order for our artificial intelligence to be a true long-term profitable trend. Otherwise, it's just chip stocks. And on one hand, as I've taught before when we've talked about stocks, chip stocks are the foundation to artificial intelligence and therefore worthy of investment. But if companies that are buying these chips aren't generating profit from those chips, they are not going to continue to buy those chips because there are no profit expansions for them. So that's what I mean by the chip stocks can't be the only companies profiting from AI. And other companies need to be able to dictate where those profits from AI are coming from in order for Wall Street to continue to build on what has been a 2.5 year trend in the growth of AI since 2020, 2021, 2022. The Fed, any economic factor that further reduces the outlook for rate cuts will be a negative to the market. Remember, however, two things. Number one, Wall Street always moves the goalposts. Like last year, when Wall Street expected 6 rate cuts, they got 3. The market was still up 24%. So the Fed's actions alone are not going to create a bear market, for example. Uh, but the biggest fear Wall Street has is that the Fed will not cut rates at all in 2025. The reason that the market went down 1.5, almost 1.5% on the Fed announcement day or following the Fed announcement day was because that was the fear. That was the sell the rumor, excuse me, um, that the Fed would not cut rates at all. That's not what the Fed said. They still forecast 2 rate cuts. That can change based on economic conditions. It can change to more rate cuts. It can change to fewer. But there is an impact from the Fed. But right now, I think that's lower on the list to me. This list is almost in order of how I see things affecting the markets most. ISM Services PMI reported monthly from the Institute of Supply Management. Uh, Manufacturing's PMI has remained in contraction since December 2022, so going on 2 years now with a sub 50 reading. But the more important metric is the services PMI. As long as that services PMI stays above 50, then that means that there is still growth in the service sector. The economy is 60% plus service based. That's fine. If that falls below 50, we may have issues as it relates to the economy, especially if it falls and stays below 50 level for 2, 3 months or even longer. We're not there. ISM services have been comfortably above 50, but it is a key thing to watch. And then trade wars, I don't know what's going to happen with the tariff stuff. Um, but if they are enacted on a global basis, that will be a net negative. That is not what Wall Street is expecting. Wall Street is expecting tariffs to be used as a negotiating tool, not as a hammer. Um, so you have to keep your eye on that. If those come out as global tariffs, that's going to be a net negative to Wall Street, to the markets, um, and ultimately to the economy. Everyone has said that. I mean, there's no argument about that whatsoever. So this is why I say the last 6 weeks gives you a preview of 2025 because Wall Street has consistently reacted to uh, future news, things that have not happened but may, as it relates to the incoming administration, specifically around economic agenda, pro growth policies, tax cuts, etc. So, but the tariffs are the most important and most negative of those things. So, that bears watching. We'll keep you posted and do our best to keep you out of the way of anything that moves negatively when we get into the new year. The two most interesting charts, this is a combination of the U.S. 10-year U.S. Treasury yield on the left and the S&P 500 on the right. You can see the big red bar on, what was it, on the 18th of December. That was the day that the market, that Wall Street reacted to the expectation of pausing or no rate cuts in 2025, and then rebounded when they realized that that wasn't likely the case. But you can also see the sideways and then the fall off the shelf mirrors the time frame of the 10-year yield rising from 4.2 to 4.6%. That's what I mean by the impact of the yields on the S&P 500. That's why we want to keep our eye on it, why we will continue to watch it, and that's why these charts are interesting. Grain of salt, but last Friday, Treasury yields reached 4.7%. You had a pretty negative day, down 1.2%, and then they pulled back from that brink back down to nearly 4.5%, and the market has been a little more sideways since then. So that's why I bring this to you and share it with you. And again, I will keep you updated as it becomes important. This fall, we released a new complimentary report called the Weekly Income Report. This is published on the Traders Reserve website almost every Monday. If Emily is traveling or handling other issues, we may delay it sometimes to a Wednesday, but typically it's published every Monday. It's also sent to our free email subscribers of Filthy Rich Dirt Poor each week. This is an overview of the prior week's closed trade performance across all of our services. So this is a way for everyone to keep up on what trades or which trades were closed, what was based on how we traded them volume wise, contract volume wise, what was the net gain, the net loss, where they happen, what was the overall income for the week across all services. And then we couple that with trade analysis, whether the trade is good, bad, or ugly. We pick one trade each week and provide you with an in-depth analysis of that trade. Emily has done a phenomenal job providing ways to view how we've handled some of our trades. That can be anything from a trade that just worked out brilliantly or a trade where we had to go through a period of recovery. So as I said, the good, the bad, and the ugly. You should be reading that every week. There are lessons to take away, things that you can implement in your own trading, as well as obviously, in some cases, not all, the bragging rights of our services. So since we began publishing this in early November, our total income, $14,780. Remember, that's at the level that we're trading at. So whether we're trading 1 or 2 or 5 contracts per trade. So those results right now are represented from our 5 core option services. In 2025, we'll start including the 3-stock strategy and the growth portfolio in there on a 3-stock on a regular basis, growth portfolio probably on a monthly basis. But the average across all of our services in those 9 weeks, $1,600 per week. That's not trading at scale. That's at base small minimum levels. But that translates out to $85,000 in annual income. What's interesting about that to me is that's not dissimilar from some results that I'll share with you here in just a little bit. But the key here is this is all of our services combined. So you may not be in all of the services, but it gives you a broader view of if you were trading more widely, right? What would the real impact be? This includes gains and losses. So we don't not publish our losses. We do each week. In fact, last week, the December 20 report included a $6,000 loss at the 5K challenge level. The November 15th report included a $3,500 loss for SPX1. So you can see the net impact across a variety of closed trades. Was I profitable? Was I not? Did I have a big week, a small week? Smaller weeks don't always, like the $978 may just represent a week where we didn't close many trades. Does not necessarily mean that that particular week had losses. You can go back to through all of the weekly income reports published over the last 9 weeks at tradersreserve.com. But I would make sure that you're getting at a minimum, getting the email report each Monday so that you can get instant access, easy access, and follow along to see how we're actually doing. So some reviews from 2024. The results that I'm going to share with you are based on our trading of recommended trades, meaning if Dave sold one contract, our results reflect one contract. If he sold five, the results will reflect five contracts. Our results are not going to match yours. You know that, we know that. But it is to give you a guide for how services actually performed over the course of the year, and also to be able to give both of us, you, Dave, and me, and Jeff, areas where we can pinpoint our focus for improvement and for better trading experiences in 2025. Results shared here include gains and losses from closed trades only from January 2 through December 30. If we closed anything today, I don't have it because obviously I had to create this presentation in advance. All open positions are not included because they are unrealized gains or losses. So they are not included in the results that we're sharing here because they were not closed in the calendar year. When we close them whether it's in the first quarter or whenever in 2025, then whatever the result of open trades at that point in time will be accounted for at that point in time in the next calendar year. Some things to work on. This is based on, and I'm going to preface this by saying that I'm probably going to sound harsh here, maybe a little tough lovish, but I'm going to be blunt about a few things. This is what I see right now, and I understand it. I understand why. But the fear of loss is greater than the desire for gain. An example, December 19th, we put on an SPX1 trade. That's a Thursday. 7:45 a.m., Friday, before the markets have even opened. Futures down 0.9%. Certainly would have impacted our trade negatively. An hour later, futures rebound. But in the space of that 1 hour, the sheer number of emails into customer service. What are we going to do with this trade? Are we going to take a max loss? Wait till the market opens. That fear of loss, I get it. You have to find a way to cap it and exercise some patience until the market opens. And the key, especially on that particular trade and on any trading day, is this: 7:45 futures are not the time to make decisions about any of your trades. 8:45 a.m., you're getting closer to reality. And the reason for that is because government data isn't reported until 8:30 a.m. and oftentimes results in reversals in the futures market. Futures overnight are reacting to European and Asian markets and news out of foreign countries. But at 8:30, they start focusing on what's happening here in the United States. And the markets are driven more by US news than by foreign news. Doesn't mean foreign news doesn't have an impact, but the impact of government news here is greater than that foreign news in 90% of the instances. And that's what wound up happening was the market reversed, the market opened slightly lower and then reversed higher the rest of the day. And we wound up closing that trade profitably. But just please be cautious about overreacting way too early before the markets open. We're always on top of our trades. We know, we knew before you knew at 7:45 that the markets were down pre-market. We are, whether it's me, whether it's Jeff, whether it's Dave, we are discussing trades by 8:30 a.m., an hour before the markets are opening, sometimes earlier, so that we have a plan, so that we know what we want to do. We don't always have the time or the capacity to communicate every level or every step of the way through that process. It's because that creates more confusion, or it leads to confusion, and it leads to overreaction. And in that one particular instance, at 9 o'clock, we were looking at, do we need to roll? Do we wait to see what the market's going to do? The implied open was 20 points. That was far out of the top of our spread. So we said we need to wait and see where the market actually goes. And sometimes that's true of all of your trades. This is not intended to be a talking to. I don't mean it that way. Um, but the number of emails of, what are we going to do about this position? We're on top of all of our positions. If we're not communicating on a position, it's because there's nothing to do with it right now, especially open positions that have been open for a longer period of time. The, there's, what are we going to tell you? We're not doing anything, right? That doesn't help you. So that's why it's the communication on open positions is as needed when we have an action we want to take or when we have a plan that we want to enact. That's when we're going to make sure that you know clearly what we're going to do. And it doesn't mean don't email customer support. It just means emailing Mike Walton at 7:45 isn't going to get you an answer because the market isn't open in that sense. So we understand, we get it. We know that it's, again, it's that fear of loss is driving people to react to things too soon, I think is the best way to place that. And be cautious about that fear because it prevents you from taking reasonable risk. An example, making a trade where you trade on, say, a basic spread, you trade 5 contracts. You lose money on that. So what do most people do? They go down and they start trading 1 contract. You, that fear of that initial loss negatively impacts your future trades. Be aware if that's happening to you. I can't fix it, only you can. I can only instruct, but I'm seeing that. I'm seeing that in comments. I'm seeing that in emails. You don't make back the loss by shrinking, and fear is going to make you shrink. My biggest suggestion for 2025, especially because I think it's going to be more of an up and down year, is to review your income performance quarterly, not on a trade by trade basis. We'll take a look at an example of that in just a minute. The concept that I shared with everybody last year at IBL of 10x is still better than any arbitrary $1 million goal. We'll review some of that a little bit later on, but that approach alone can get you over the fear hump. If you are focused on what your goals are, how you're going to meet those goals, your actual performance, that will get you over that hump. That will get you into an area where you can begin thinking 10xing your income from your, or excuse me, 10xing the value of your portfolio versus an arbitrary $1 million goal. And as I said earlier this year, I don't bring that to you just because we made it up. I bring that to you because I'm actually learning how to do that with our business. I'm following very similar principles in the idea of 10xing our business as a financial publishing company, as I am bringing to you as an investor, because there are commonalities between the two, between how we grow our business. Fear of loss for me is a serious thing to overcome in running this business. It's no different than you having the fear of loss in a trade. So when I tell you I understand, it's because I understand. When I have to spend money on advertising, I have a fear of loss that I'm not going to make back that money, and it isn't cheap. Well, it's no different than if you're putting $10,000 or $20,000 into a trade. So when I say it's not just you have to, it's you and I have to overcome that fear of loss, and we got to do it together. But that's where the 10x principles come from. Have come from work that I've been doing over the last several months in how to grow this business to an entirely different level. More trades does not equal more income. I'll show you an example of this as we look at 3 different portfolios at the end of this presentation. But it also is true when I look at the overall record of trades across a variety of services, which I'll share with you here also in just a minute. Cash producing assets. Please write those words down and remember them. I know, again, from emails, comments, etc., number of stocks that are down. You have a cash producing asset. We will leverage it together and we will produce cash from that asset. But if you can, even if you're doing something on your own, if you buy a stock and the stock goes down, you know how to produce cash on your own. Use that approach. And if we have to, we will reteach the concept of cost basis. It is the most effective method for overcoming a stock that is in an unrealized loss, but working that stock back to either a close to break even, or even a profit. Yeah, it may take time, but if you're focused on it, if you are diligent, you can always get back to a break even. Um, and a caution note: do you really improve your performance by what I call outsmarting the experts? A number of factors, people changing strikes, setting different good till canceled orders, uh, things of that nature. Uh, when we put out a trade recommendation, we can only track our results based on the actual recommendation that we place. That's based on a number of, call it a number of rules in the, not in the publishing world, but in the FTC, SEC world. So if we say sell a 60 put and you sell a 62 put because you want the higher premium, and then the stock finishes at 61 and you get assigned and we don't, what happens? Right? We're going to book the trade as closed and a gain, but you're sitting now on an assignment, and then the stock goes down 10%, and now you're in the red, but we're out of the trade. That's why I say be cautious about this, trying to outthink what we're doing, because in instances like that, we can't help you. It's not that we won't help you; it's that we can't help you because we're not registered financial advisors. Which brings me back to that idea of, well, you have a cash producing asset and you know how to sell calls, so you know what to do. So go do it. But if you change the parameters of our trades, you limit our ability to help you. And that's what I mean by being cautious about the outsmarting the experts. Uh, and again, this is kind of a year in review. So these are things that I want to be able to help people with when we get into 2025. And uh, I've seen a number of things around this service was worst year ever, things of that nature. And I'm looking at the track record and I'm thinking something else went wrong because I don't see that based on our record, and you'll see the breadth of this in a second. But before we get into the results and analysis, a few things that I want to cover. Number one, uh, so that you understand the context around options contract volume as it relates to the results that I'm going to share with you. For Options Income Weekly, it's one contract per trade. That's how we trade it. That will change when we enact spreads in 2025. Income Masters, one contract for single-sided puts or calls, typically 2 to 5 contracts for spreads, depending on the value of the spread, whether it's a 5 or 10 wide. SPX1 is now 4 contracts per trade, 2 trades per week on the same day. Millionaires Trading Club typically is 2 to 5 contracts per trade. 5K Challenge, 5 to 7. However, those results are it will be inclusive of the summer months where we were largely trading 1 or 2. So next year's results will be a more realistic reflection of that service's accomplishments or non-accomplishments, depending on how the year goes, but we'll go for accomplishments here. Because we'll be trading at scale inside of 5K more consistently when we get into 2025, or as we get into. And perpetual income, now part of Income Masters, 1 contract per trade. When I talk about eliminating the fear of losses, this is the trade count for the year. So we'll quickly go through this on the left side. For Options Income Weekly, total trades recommended in the calendar year, recommended closed, 83 trades, 80 wins, 3 losses, 96.4% win rate. That's published losses. That is not open trades. Remember, please. Income Masters. I have 2 categories for Income Masters. I've separated out the Income Madness events from the regular trading in Income Masters, and I'm not accounting for perpetual income, which I'll explain in just a moment. But for Income Masters, regular trades, your regular trading sessions each week, 163 trades, 153 wins, 10 losses, 94% win rate. For Income Madness, we made a total of 95 trades, 88 wins, 7 losses, a 93% win rate. For the SPX1, I don't have today's trade. I don't know where the market is right now, but Uh, if that trade closes profitably, we'll have made a total of 50 trades. But for the year so far, 46 wins, 3 losses, 94% win rate. 5K challenge, since we made the changes in the summer, 44 trades, 39 wins, 5 losses, and 88% win rate. And Millionaires Trading Club, this is more event style, so the trading volume is not going to be significantly higher on an annual basis. But 41 trades, 32 wins, 9 losses, 78% win rate. So for the full year, 475 trades, 438 wins, 37 losses, 92.2% win rate across all of our core options trading services. Now, notes, things that matter. For Options Income Weekly, one significant loss in Intel cut the overall income by 50% at one contract per trade. For Income Masters, your total losses booked $14,506. For Income Madness, total losses were $7,205. So for Masters, a couple of notes, and Dave will be doing a review with you in not this week, but next week, I believe. But as we look back through the course of the year, the spreads in Income Masters were both a positive and a negative. The positive, the spreads ran at a 7-to-1 risk reward ratio. Single-sided puts ran at a 1-to-1 based on average capital per trade. So the volume of gains and losses was higher, largely due to spreads or to the use of spreads versus single-sided puts. However, we wound up carrying more open positions on single-sided puts due to assignments. And that obviously changes the math for those particular positions. I mentioned perpetual income isn't tracked in this manner in part because of the nature of the strategy, where we are selling puts to take assignment, we're selling calls to generate capital on that assignment, on those shares, and we're attempting to collect dividends. Appreciation is not, it's like tipping at a at a Starbucks. It's not expected, but it's appreciated, right? It's thank you. But what we do is track any plus or minus in the appreciation column separately by position and included as part of the total result of the trade because it's a long-term position. It is not a single transaction or an in and out type of trade. For the SPX1, total losses, $4,500, just over. Millionaires Trading Club had one negative, the UNH trade, largely due to the assassination, but also a great lesson here in sometimes it's better to take a loss at a small level, whether it's $500 or $600 or $700, rather than try to rescue every single trade. This one, because of the assassination of the CEO, wound up being a $3,000 loss. That cut our event gains, which were running just over 10,000 for the October event, cut them by almost 30%, a little over 30%. And even 5K challenge, one big loss, reduced gains for the half year by $6,000. Well, part of that is because in the summer we were trading small and we didn't start ramping up our contracts until early to mid-October. So that one loss had an outsized impact on the 5K challenge results for the year, which you haven't seen yet. You'll see them in just a second. But an example of something I mentioned earlier about assess your income performance and your overall performance on a quarterly, not a trade by trade basis. If I take a look, or as we take a look at the SPX1 for 2024, the quarterly performance, some quick notes. In the first quarter, we were trading 3 contracts per trade. In the second quarter, we changed to 4 contracts per trade. April is actually a blend. We were 3 contracts in April, and then in May, we started trading 4 contracts. But the total income from the year over $7,600, not including the current open trade. But each quarter was positive performance. Even including a $3,500 loss in the fourth quarter, each quarter was positive performance. And that includes also in the second quarter, a large loss in April. Now, I get worrying about one trade wiping out multiple weeks of gains. But if you're looking at your performance on a quarterly basis, the math is different. Now, if you just start out with any service, doesn't matter whether it's one of ours or not, and your first trade is a loss, yeah, you have to work back from that. I understand. But when you're assessing something and taking, whether it's this income masters, doesn't matter what service, taking a longer term view, did you end the year profitably? Did you end the quarter profitably? That's that's why I say, especially for 2025, this is where I think the people who can overcome some of the fears around losing trades, around losses, around large losses. If you're assessing your performance on a quarterly basis next year, I think you will have a you will drink less, eat less, exercise more, and live longer and healthier lives. Uh, and again, we're profitable for the full year. And in the last 7 weeks, 6 weeks, we've made up almost 60% of that November 14 loss by the minor change that we made in doubling the spreads, but maintaining our capital. That's what I talked about earlier. We didn't took a big loss. We didn't go down to one contract. We kept our contracts consistent. And that's why that performance on a quarterly basis, it may be small today, um, but it was still profitable. It hurts. I know. We don't want you to take a big loss. We don't want to recommend a trade that turns into a big loss, but a loss is going to happen. The question is, like as I shared earlier in the fall, what happens with your very next trade, with your very next period, your next performance period, right? What happens in the first quarter? If we're profitable through the first quarter, we're going to get off to a big start. The consistency in applying, and I'm not just leaning on SPX1, but it because of the limited number of trades and the impact of a loss, it's an excellent example of how that one loss can negatively impact people's perspective on the approach. The trading may not be for everybody, but ultimately it ended the year profitably and strong. So our actual results, again, these are what I call minimum income based on those contract volumes I shared with you earlier. So if a trade recommendation goes out and it says we're selling 5 contracts, that's what's tracked. If it says we're selling 1 contract, that is what's tracked. So working from the service across, the capital column in some of these cases is going to be an estimate because capital changes too frequently to say that this is exactly the amount of capital that would have been used across the full year, and that has an impact on the return columns. So be aware of that. But what I'm really focused on is the total income generated across the full year. And we'll start at 3 stock. I'm not sure how many folks joined me earlier this month, or back, excuse me, on Cyber Monday. But as I shared with you, 3 stock was largely flat from the summer months on. We had a couple of good months. We had a couple of bad months. But most of our gains actually came in the first half of the year. And we've largely held those gains. We still beat the S&P 500. So we're up 38%. Greatest year ever? Nope. We can do better, which is why we're making those changes. But it was profitable at the end of the year. My 2024 growth portfolio, which I gave to Investors Blueprint Live attendees, is up 43.5% for the year. Options income weekly. Remember, I said a moment ago that one trade negatively impacted 50% of the results. That was Intel, which was a $3,000 loss. So the net here is about $3,000 at 1 contract per trade. That estimate about $36,000 operating capital on average across the course of the year. Low return, 8%, conservative return, I guess you would call it. But it made it profitable even at 1 contract per trade. Income masters 22,586. That number is based on the regular trading that you do each week with Dave. The income madness component for the year was $11,163. That includes the large loss on SMCI earlier in the February event. And perpetual income, I'm accounting for this on the full year basis because that's what I have to work with. But perpetual income significantly outperformed in 2024 at 23,500 across a breadth of trades. Again, remember, I can't account for open or unrealized gains or losses because those are ongoing long-term positions. So I'm only accounting for what was traded and closed during the course of the year. SPX1, 7,659, a 124% return on capital. That might be why I keep talking about that service. And that's inclusive of a $3,500 loss in November. 124% return on capital for the year. Millionaires Trading Club, 25.3%, a little over $9,200. That's from the July, August, September pre-conference events, plus the full trading of the October event. But I believe there is still one position open from the October event. So I have not accounted for that yet. Excuse me. The new Millionaires Trading Club VIP monthly trading, putting on 4 to 5 trades, 1 day, 1 hour, hour and a half session per month. We've already booked over $1,620 in gains on an average capital outlay of about $8,500 per event. So 20% in 2 months. Looking pretty good. 5K challenge, again, with having gone through changes, with Chris stepping away, modifying the service and training small in the June, July, August, September periods, and then starting to ramp up in October. We're up $10,000 for the year, so we'll finish the year with profitably, but that service is going to be much more active and aggressive in 2025. So if you're a part of the 5K challenge, you should get excited for that. So total income here, 105,000, an estimated 24% return, could be higher, could be lower based on actual capital accounted for. But overall, getting people over 6 figures across all of our services, yeah, it took all of our services. That's where I think we can make some improvements, especially depending on your goals, how much time you want to spend trading, what you want to trade, how often you want to trade, things like this. So we'll take a look at that here in just a couple of seconds, because next we're going to project income for 2025. And this is a fun exercise. I will walk you through my process so that you can learn to replicate this for yourself. I'm going to look at 3 portfolio levels, 50,000, 100,000, and 250,000. I'm going to, this is not a sales presentation, so please don't take it that way. But where is capital best allocated? Based on the actual returns we generated in 2024 in order to project potential returns forward. But those projections need to account for losses in the return calculation. So I know that if I know what we had as a loss rate, then I can take that factor, or I can factor that in as part of the total income, the total rate of return on capital, and then say, I can then project that number forward. I'll show you that here in just a second. The two most important things to remember are this: it's a goal. It's not a guarantee, it's not a promise, it's not a prediction, it's a projection, it's a goal. If you don't set a higher goal, you'll never know what's possible. That doesn't mean you have to be a day trader. It doesn't mean you have to take on extreme risk. But if you don't set a higher goal, you have no way to get there except by luck. So this is a way to think through and strategize forward. How can you do better next year than you did this year? Even if it's 10% better, right? So the key here is small equals large. This is jumbo shrimp, military intelligence, small equals large. On the left-hand side of the table are the services. 3 stock growth portfolio, which I haven't shared with anyone yet. I'll come back to that in a second, if I remember. Options Income Weekly, the Income Masters, that's the regular trading, Income Madness, Perpetual Income, SPX1, Millionaires Trading Club, that's the monthly event, not the live event in the fall. I'm not accounting for that one here. And the 5K challenge. So if I take what our actual return multiple was, for example, for 3 stock, roughly 40%, and then I divide that by 12 months, that gives me a monthly return of 3.3%. It's not very much, is it? Right? You look at some of these numbers and they're actually kind of small. For Income Masters, 1.25% is below normal, right? Normally we want to be targeting 2 to 5% for Masters. Okay, well, if we project at 1.25% and then we do better than that, then we should be able to outperform our expectations, outperform our projections. Same with perpetual income, SPX1. SPX1, the 124% accounts for two large losses that negatively affected the overall results for the year. But I can still project out that over the last 2 years, I've done better than 100% returns. So if I maintain that pace, then that's potential monthly return of 10%. Uh, Millionaires Trading Club, take it with a grain of salt because it's new. We've only had two monthly events of the scheduled 12. So I can only work with what I have, but it still needs to be projected because we're largely trading spreads and trading them at 2 to 5 contracts per trade. It is not improbable that we can maintain somewhere around a 10% return per event, per monthly trading event. Um, 5K challenge, right now I'm only projecting that at 2. I actually didn't use 5K challenge in these projections um, because I don't have enough good data to work with. They didn't start scaling until October. 3 months of data on that one is not what Dave is actually after here. So what I mean is that he wants to be more active, more frequent. And I think that will start to happen in the first quarter. So I think for 5K challenge, while I didn't use it, I will start updating that as we get through future quarters and future quarter performance reviews. All of the steps that I'm walking you through here are based on my 10x portfolio principles. These are the same concepts that I'm in essence that I'm beginning to enact in business. Use income generated to fuel growth of investing portfolio. So if you're trying to grow you're not necessarily taking everything as income that you need right now, and you put that back into a growth portfolio, that is the conduit to faster growth of your money. Remember, more trades doesn't necessarily mean more income or more gains, but having a way to leverage your income into a growth portfolio, could be the S&P 500, an index fund, is what does start to scale up your money. And think forward. This is a newer idea. I'm going to be covering this again at Investors Blueprint Live in February. But if you exceed your weekly or your monthly goal, set aside that excess income for a future week or month or quarter so that it's protected, right? Or it can help you to absorb a loss in a particular week or month. Uh, I don't, I think this is more of a column A, column B approach, but if my goal is $500 and I make $600 and I set $100 off to the side and I say I don't need that right now, but I can use that to either reduce a goal for a future month or to start building up for a future month or a future quarter, right? You're creating income into the future versus the income you need today. The most important question here is how much time do you really want to spend trading? I can't answer that for you, but the way that I built these models is to keep it as simple as possible, to give you more time for golf, more time for travel, more time for fishing in the Gulf of Mexico, more time for crochet or croquet, whichever is your fancy, right? But only you can answer that question. How much time do you really want to spend trading? Velocity continues to be the most important factor here. That's the rate of change of your money. So the sooner you can close a trade and open a new one, the faster you can compound the gains from that first trade or the income from that first trade. That is essentially what the one of the underlying changes to the 3 stock strategy that I shared with you earlier. Increasing the velocity by being willing to take gains sooner and then put that capital right back to work. And remember this, if nothing else, remember this, the simplest investing model, the Warren Buffett investing model is this, 10-30-7. That's $10,000 per year invested in the S&P 500 for 30 years, earning an average of 7% per year, gets you to $1 million. That's it. It's that simple. If you have that 30 years, even if you don't, 20 years is going to get you halfway to 3/4 of the way there. right? 10 years is going to get you part of the way there. That simplest investing model is always your protection. The hardest part is that $10,000. So going back to point number one here, if you generate $10,000 and stick it in an S&P 500 index fund and repeat that process each year, that is how you start growing your money exponentially. Not by moving to more trading, more day trading, etc. On one hand, keep in mind, I'm telling you, trade in a sense, trade less, despite the number of services we have. Bear that in mind. All right, the aggressive investor. You're going to think this is aggressive, but it really isn't. It's going to look aggressive. Ironically, it isn't. First and foremost, this approach, this concept, mixes short-term stock and option strategies with a longer-term investing approach. This is the basis for the 10X principle. Short-term stock strategy, 3-stock trading strategy. Longer-term investing approach, my growth portfolio, which I haven't shared with you, but at some point, some of you will have access to it. That's what I mean. Short-term option strategy, SPX1. Longer-term investing approach, perpetual income. Blending those has the power to give you bigger and better returns in the future. It also gives you a way to keep time to a realistic minimum. If you don't want to be trading all day, 5 days a week, good. We don't either. But what's your timeline? In other words, what is your minimum time? 1 hour, 5 hours a week. It's going to be different for everybody. The ultimate goal here is to get higher rates of return by concentrating capital in those areas where you can get the best returns for the least amount of time. So let's take a look at a $50,000 portfolio. Excuse me for 1 second. Remember that many of these things are not going to work out exactly the way that they are projected because the future is not knowable. That all of the income projections here are based on the actual returns we produced in 2024. So I'm not creating new projections. I'm basing it on what we actually delivered to you this year across these different services. That's that table that I shared with you. That's the multiple and the monthly value. So a $50,000 portfolio, blending short-term options, short-term stock, and longer-term investing. This is where I would be focused. 3-stock strategy. I would actually use 1.5 times the capital, so $15,000. Excuse me, $10,000 in a growth portfolio. The SPX1 trade like we traded, 4 contracts times 2 trades is $8,000. That's actually generating about $400 per week right now. But I account for losing trades in here, so I'm actually projecting that out as $800 per month. Millionaires Trading Club is producing a 20% return. A 10% return on average per month. It's 9.5. So that's factored out here, but that's not off from what we just did. We just did $1,600 in a number of trades. We still have some trades open. It works. And keeping that capital to about $16,000 allows you to scale trades beyond what we're doing. So if we sell 2 contracts, you can sell 4 or 5. That gets us total capital allocated of about $49,000, potential monthly income, $2,200. That's a 4.5% return per month. An annual income goal, not a guarantee, $26,000 or a 54% potential return on capital. That's an aggressive investor, but what about time? 3-stock strategy might be 30 minutes a month, maybe. I mean, it doesn't take that. We do most of the work for you. It doesn't take that long to set up the trades or to execute them on the in or out. Growth portfolio, 1 hour a year, set it, leave it alone. Don't mess with it until the end of the year. That's what I did. SPX1, the SPX1 trade, maybe 15 minutes a week, right? You're on that webinar basically from 3 p.m. to 3:15. You're setting the trade with Dave, and then you're setting the good till canceled, right? You're setting the good till canceled, and then you don't have to mess with it the next day. unless we have a losing trade, but you generally don't have to do anything with it. Uh, Millionaires Trading Club is an hour and a half a month. That's so overall, you're talking about one, three, maybe 4 or 5 hours a month. So that's pretty limited amount of time for potential spectacular returns. Is it going to work out exactly this way? No, I know it's not. You know it's not. But if we don't set a goal like this, you don't have a path to get there. How else would you, on a $50,000 portfolio, potentially get $26,000 in the next year? Right? That's the purpose in this projection and in using or approaching it in this way. And by accounting for the actual, or using the actual performance to account for things that went wrong in 2024, then I have at least a realistic basis in my expectations in monthly income, and I can adjust this as I go through the year. So if one service or another is outperforming or underperforming, I can adjust this model so that I manage my expectations and I continue to manage and maintain my projection for what my year is going to look like as I go through the year. Let's take a look at a $100,000 portfolio. This is, again, is a little more aggressive. This is adding in, first and foremost, income madness and perpetual income. Not the regular trading in income masters, but just these two components, because again, less time. Income madness, typically 4 days. We will be a little more aggressive in running it probably every other month in 2025, but 4 days, 1 hour per day. So that's not a lot on a monthly basis. Add to that perpetual income, which is typically managing 2 to 3 positions per week, not an extreme amount of additional time. We covered SPX1, we covered Millionaires Trading Club, the growth in the stock. But again, you have this income being generated across these different services that gets put back or can be put back into that growth portfolio or the 3 stock strategy if you choose, or an SPX index fund. But how you use this income ultimately is up to you. But this projects out very similarly in terms of return on capital. Sorry, there's a mistake on this one. It says weekly income. That's supposed to be monthly income. That's my fault. These last two tables will probably both have that same error. The right-hand side should be monthly income, not weekly income. And it should be a monthly return on capital, not a weekly return. So the monthly return, 4.5%, annual return, 52%, annual income, 52,000. And all you're doing is either increasing capital in certain categories like Millionaires Trading Club, or adding in 1 or 2 things: income madness and perpetual income. Here's a $250,000 portfolio. This again is largely expanding the capital leveraged across these different categories. Comes out a little bit lower in the overall return. I'm not fully capitalized here. That's not a bad thing, but that gives me some flexibility in how I may want to use that additional capital. The more capital you have, the more flexibility you have to keep cash on the sidelines for special opportunities, for hedging against negative events, things of that nature. The less capital you have, the more fully you have to be invested in order to get higher returns. In order to set a higher bar and achieve it, you have to be more fully capitalized. Literally at less than $200,000, you have to be 90 to 95% capitalized. I mean, even on the 50,000, I left you $1,000. So that's lunch money. We were right on 100,000 here, but we were off by about 20,000 here. So again, this is a little bit lower because of that, the capital being put into income madness, for example, trading that at a little more scale on with spreads, especially. So that's a lower rate of return on an annualized basis because there are only 6 events per year. So that's one of the reasons why that annual return is actually lower than the other 2 services. But overall, that's a potential almost $10,000 in monthly income. Can you do better than this? Absolutely. Do you have to follow this model? No. But if you don't have a way to look forward, what do I want to trade? How do I want to trade? How much time do I want to trade? What are my goals? What are my objectives for the year ahead? Where do I want to make the most money? This is a 6-figure return, $110,000. That is not off that much from the 105,000 we produced this year, and doesn't include three categories: the 5K challenge, the regular trading and income masters, and options income weekly. At these portfolio levels between 100 and 250,000 and above, options income weekly is not the best use of. I don't think it's the best use of your capital. Not enough trades, not enough trade volume. You're getting more juice out of income madness. You're getting better returns out of perpetual income. That's where I would be focused, especially in a more volatile year like next year, which I expect. Millionaires Trading Club, again, you're in and you're out in typically 7 days from our trades. Some trades will run a little longer, but we're only trading once a month, so that capital is in and then it's out. There are other ways that you can approach this. This is literally the Ginsu knives approach. You can slice it, you can dice it, you can chop it, take your pick. But I might want to use my capital for Millionaires Trading Club 1 month and then take that same capital and use it for Income Madness the next, or within the same month, right? There's flexibility here. This is not hard and fast. Uh, these are not hard and fast rules or capital allocations, etc. Right? They're generalized because there's no other way for me to do that. Um, but you have that kind of flexibility. So maybe you want to trade income madness at higher scale, at like 10 or 15 or 20 contracts per spread. You can do that. Um, you can take capital from one category and increase it in another. And then as you get actual results, have a way to then take that and say, here's what I'm going to do the next time there's an income madness, or the next time there's this event, or this service is putting on a trade, etc. This gives you that capacity and that flexibility, and it gives you some place to store capital for growth of money in three stock and in the growth portfolio. Uh, so it is as well-rounded of an approach across all three portfolio levels as I can present to you. So um, we will continue these performance reviews in 2025. Give me just a second here before I lose my voice. Sorry about that. We will continue these performance reviews at the end of each quarter in the new year, and then we'll do another annual at the end of next year. Save these portfolios, and let's see how these actually would turn out by the end of the year, by each quarter even. It will include all services for both stocks and options. So I'll have my growth portfolio and three stock in there. We'll also include forecasts for the next quarter, similar to our look ahead at the full year. And then we'll assess our annual progress. How are we doing? Where can we make changes, improvements? Where do we need to focus our efforts, et cetera? And I think that where I really see that having impact is for folks who are in 5K. I kind of ignored it. Don't take that as a negative. I want a better baseline for expectations, which need to be met in the first quarter. And so we'll start building in what people can do on that side of the services as well. Um, and then and anything new that we happen to bring along to you in the new year. So I will make these slides available to everybody. So I saw the question there. So give me just a second to work through and see if I need any questions here. Got a lot. Get back to the start. Happy New Year. Thanks, Don. Appreciate it. Creamed herring is great. No, no, it isn't. No, it is not. What or how would you recognize AI migrating to broader market? Great question. What you want to, well, harder for an individual investor to look for or see this. However, earnings reports is the number one place that I would be looking at. So earnings conference calls, when CEOs or if CEOs are highlighting specific revenue, specific growth in revenues attributed to artificial intelligence initiatives, which they have enacted in their business, that is how it would be realized. That is how we would see it in the broader market. Are you looking at any of the data center stocks, which did so well last year as additional investment of ideas? It did very well with DLR and IRM. I'm not surprised with IRM. IRM is a very high quality stock. It was a perpetual income stock for a long, long time, and if it's not still. but I would suggest, first I would say maybe, um, because really what's the difference in a data center stock, Anita? That's one where I need to look at the company and figure out what they do and have a better sense of, does AI really propel their business? One of the companies, not in data centers, but one of our three stocks right now, Palantir, is leveraging artificial intelligence. If I remember correctly, they just got like a $600 million Army contract, which is attributable to their artificial intelligence initiatives. So that's an example to answer the previous question from TBHDGS Driver. Um, of how do we recognize this? How do we see this? So that artificial intelligence in Palantir, and Palantir was just written up by or called out by Dan Ives. There's a story over at CNBC. He's saying the run in Palantir is not over, and I think he's right. I think that stock still has significant growth potential. That's a stock that's currently sub 100, but I don't think it's going to be for long. But that's kind of why. So it depends on how is a company like Iron Mountain, or is a company like Iron Mountain, IRM is the stock symbol for everyone else. How are they leveraging artificial intelligence within the confines of their data storage, data collection, data storage, data management? But great question, Anita. Thank you. Uh, Drebeck, if we are currently in income masters in OIW, what is the difference given the change to OIW adding spreads? Volume of trades, number one. Why would anyone want, so the reason for Options Income Weekly's existence is it's a starting point for someone who is, for example, previously a buyer of options, never a seller of options. Um, Income investors who are just sticking their toes in the water in the options market. So that's why I say it's the learning ground, it's the training ground, it's the practice ground for generating income. That has part of that long-term arc for that particular service is the change in a number of investors who are looking for alternatives for income from 5, 6, 7 years ago. Uh, and there really, I don't know that there are many great outlets for learning how to sell options. I'm not saying we're the best. Maybe we are, maybe we're not. But what I am saying is there are not many outlets for being able to learn that. Um, so the annual return target for Options Income Weekly is our target is 16%. It might be 12 to 16% to be sort of a blended average, but the incorporation of spreads will give us a little bit of a flexibility in the annual return. What I really would look at is the income. At $50,000, I want that to produce $500 per month. That's $6,000. That is a reasonable rate of return. It's not, it's a 12.5% return, 12% return on $50,000. That's a conservative target. For somebody who's just getting started learning how to sell options, that's a reasonable target. Trying to go from never having sold an option to 40 or 50% returns, uh, sure, it can be done, but I don't think most people are going to take on that amount of risk. So we want to be able to keep them in the shallow end of the pool and then drown them, right? So move them to the deeper end of the pool over time. But great question. Thank you. Kudos to Emily. She's really developed a strong skill set. Thank you. Appreciate that. Emily will probably appreciate that. And she did. There she is. Leslie and support, always with excellent responses. Indeed. Thank you. And remember, both Mike and Leslie are going into their 10th year as Traders Reserve's support, customer care support, um, taking care of everybody. So 10 years. That's pretty cool. Um, Very good summary. Thank you, Earl. Appreciate that. I said, yes, I'll get the slides out for everybody. Thanks for the webinar. Appreciate it. Happy New Year to everybody. This is the most informative summary. Capsule, thank you. Appreciate that. Yeah, I was really excited to be able to do something like this, in part because it was the best way to present the performance of all of the services together, even though some of these services aren't going to be right for everybody. So 10X, thank you. Appreciate that, HH. Oh, and HH, just a quick note. I think Emily answered you yesterday on the three stock. One of the reasons in looking at equal capital versus equal shares, uh, has to do with the direction in the markets. And equal shares for me is more important when the market is trending lower because it gives you more capital protection. Number one. And number two, the second thing that I'm working my way back through the numbers in 2024 before I present this to Three Stock Strategy members. Um, and I hate to have to admit this, but I'm going to admit this. If we had gone with equal capital back on November 8th, we would be up 10% on our three stocks, even though two of them are negative. And the reason has to do with the higher priced stocks having a greater impact in the loss column than the gain on Palantir. So Palantir is up roughly 40%. It was $55 when we entered. That's roughly $80 now. If we had done equal capital at, say, $3,000, just to round it off, we would have owned 50 to 60 shares. The gain on that would have been substantially greater than what it is right now. And that is in part due to the difference in prices in the stocks. It is also partly due to the direction in the market and how that shifted. So it was a great question. And we were originally going to build a calculator. I will get at least a spreadsheet that folks can use or instructions on building one because it's not hard. But with the old developer left our contract service, so we have not gotten around to building a new one, but at some point I would like to be able to do that. So thanks for that one from Paris. Thanks, Franklin. Love Paris. I was there last year with my wife Liz. I have not listed my 2025 growth portfolio for folks attending IBL. Apologize, still trying to catch up post-holiday. I have an update coming to you folks tomorrow on New Year's Day. Because of the way that the market moved in December, I have thrown out what was originally scaled down to about 55 stocks. I've thrown those out and I'm starting over. The change in direction by Wall Street, especially as it relates to big tech, mega cap tech stocks, et cetera, is impacting my views for next year. So I'm going to start over this week while the market is closed and come up with a new subset and then rebuild a growth portfolio. I will tell everyone one company that I do plan to hold over from this year to next is Netflix. As I said last year, the reason I selected Netflix is because they had finally figured out how to make money from their subscription base. When they eliminated the ability for people to basically share their subscriptions with friends and family galore, the company has truly figured out how to make money. That's number one. Number two, the second reason I'm going to stay with Netflix next year has to do with the Hollywood strikes. Remember, we had Actors Guild and SAG, Screenwriters Guild, that were both on strike for periods of time. Well, that negatively impacts production, except for Netflix because they do a significant amount of production overseas. And I mean, I don't know if you watch Netflix, almost everything is produced in like Norway, Iceland, Sweden, Denmark. But the one thing that does or has done is it has delayed production for many other services, Apple Plus, Amazon, MGM Plus, Paramount, etc. So Netflix was ahead of the curve because they didn't have as much of an impact or didn't suffer as much of an impact. But some of their best series are coming back in the next 6 to 12 months. I know this because my wife literally has a calendar of all of the shows on Netflix that we have to watch. And I think they continue to grow their user base and continue to succeed in the growth of their subscription. And I would not be surprised if Netflix doesn't do a stock split at some point, especially if they keep growing up toward the $1,000 per share level. And I think that gets more people into Netflix as an investor. But I think that I do see that company continue to maintain the growth of earnings in that particular one. 30 p.m. explanation of each service included. Yeah, and then you're all lucky. I did actually click the recording button. So for members of all of our services, we'll make sure that this recording is posted to the dashboard here at Traders Reserve Live. And for anyone who's not a member of a service, I think I'm going to post this to the YouTube channel. Talking about loss-making trades, full year's analysis, some of the losses. tendency to move individual stocks way outside. Yeah, and Brad, that's a good point. I think we've seen a lot more outsized moves, like moves that shouldn't happen, especially on earnings. I mean, every earnings um, uh, beat or miss is 15%, right? It's either up 15% or it's down 15%. And that's been happening throughout the year. I think I mentioned that back in April of this year during a webinar. Like, anytime a company is missing earnings, it's like bam, down 15%. You know, years ago, a company missed earnings by a penny, the stock might go down 2 or 3%. Now it's like bam, everybody's running for the exit. So you're right, you are seeing outsized moves, and that's one reason why when I do, for example, when I do my growth portfolio, I'm probably going to stick to 12 stocks for 2025. I may go as many as 15, but I'm not certain about that. We'll see at the when I get the final list and what makes the final cut. But I'm focused on consumer cyclical. I'm focused on utilities. I am looking at energy because I think there's an energy rebound coming. Um, I'm also looking at financial. Those are four core sectors that I think will be more stable than technology in 2025. But we'll see. Thank you, Johnny. You're welcome. Happy New Year to you too. Three stock yesterday. Please check with Leslie. Make sure that you're still a member. Mr. Drabeck did respond. Great. Thank you. Elizabeth Clare, Happy New Year. Great to have you along. Thank you. Yeah, I will make the growth portfolio available to everybody. I'll give you details on that by email. It's remember for folks who are attending Investors Blueprint Live, it is included with your ticket, so you don't have to do anything. For anyone who's not attending Investors Blueprint Live, we will make it available at a reasonable fee. It won't be much. It'll be the first time that I've ever done that. So let's hope that that goes over well. Marianne, thank you very much. Yeah, my son writes scripts for them. No kidding. Congratulations to your son. That's great. Uh, a lot of good shows that are out there on Netflix we've had some fun with. So tell him we said thank you very much. Let's come back. I'm on the TRL chat. Give me a second. I'll catch up over here. Uncle Donald says invest to win, not invest to lose. Yes, slides will be available. Thank you, David. Happy New Year to you too. I took care of Anastasia's question on the growth portfolio. Yoo-hoo to Mike and Emily, absolutely. And Leslie. Lions, good question, James. I'm going to go with a final score next Sunday night of Detroit 35 and Minnesota 27. So I think the Lions win it. I think if you compare the schedules and common opponents, the Lions have just outplayed the Vikings hands down. Vikings have gotten away with a lot of good luck plays. I think their luck runs out next Sunday, but we'll see. I mean, they were getting their butts handed to them by San Francisco for 2 quarters, and then reversed that flow. So at any rate, yeah. Let's win the division. Get that number one seed. I can keep the Lions flag out for another month and a half, and that'll keep my father-in-law happy. So, all right. Happy New Year to everybody. We'll get access to the recording out to you guys most likely by late today or tomorrow morning, and then we'll include a link for the slides, and we'll send the slides out by email as well. Thanks for being a part of Traders Reserve this year. And we'll see everybody again in the next trading session somewhere on the 1st, I believe we have at least SPX1. So we'll get that scheduled on the calendar and get underway here with everything very, very shortly. Thanks again for joining me. Happy holidays, Happy New Year, and let's have a great one. Oh, there's another question. Let me take this one real quickly. Hang on a second. Yes, HH. Marquet will be presenting again. I'm actually talking to her on Thursday. She will be at IBL 2025, I believe. this February. And we are discussing this week what to bring for January and for February. We have a number of ideas, but we are bringing some more of Mark K. Latimer's ideas, trading, etc., to you beginning in January. So be on the lookout for that. We'll make sure everybody knows when that's coming up, but I should have details ready for everybody after the week of the 6th. Anthony, results for three stock strategy. I must have missed that one. Um, then I'll just go with the annual. The annual result was about 37%. Might have been a little bit higher, a little bit lower, Anthony, but that was about what I had. Excuse me, that's what I had. So sorry that I missed your question from 1240 there.